Imagine investing $100,000 in a set it and forget it strategy that could bring back life-changing returns. Index funds are designed to track the overall market, making it easier to build wealth over the years. Now, among the many options, Fidelity stands out as a top choice for reliable, low-cost index funds that offer great diversification. Fidelity is well known in the investment world for its affordable, high-quality funds that suit both beginner and seasoned investors. In this video, we'll explore how investing $100,000 across Fidelity's top 5 index funds could set you on a path to impressive returns, thanks to the power of compound interest and diversification. Let's jump in. Chapter 1. Overview of index funds and why Fidelity is a strong choice. Before diving into specific funds, let's cover a quick background on what index funds actually are and why they're a favorite for many investors. So, what's an index fund? Think of it as a fund that mirrors the performance of a whole market index, like the S&P 500 or the Nasdaq. Instead of buying individual stocks, you're buying a piece of every stock within that index. This setup gives you broad exposure, which means your risk is spread across hundreds, even thousands of companies. Now, why Fidelity? Fidelity is one of the largest and most respected financial service providers worldwide, and they've earned a solid reputation for offering affordable, accessible funds. With Fidelity's low expense ratios, you save more in fees, meaning more of your money stays invested and working for you. And the range of index funds caters to almost every type of investor, whether you're focused on US companies, international stocks, or even bonds. The best part? Fidelity funds require minimal active management, making them perfect for anyone looking for steady, long-term growth without the hassle of constantly watching the markets. Chapter 2. Fidelity 500 Index Fund, or FXAIX. Let's start with one of Fidelity's most popular options, the Fidelity 500 Index Fund, or FXAIX. This fund is designed to track the S&P 500, which means it invests in the 500 largest companies in the United States across a variety of industries. Why is this a big deal? The S&P 500 is often seen as a solid indicator of the overall US economy, and it's packed with well-known giants like Apple, Microsoft, and Google. One of the standout features of FXAIX is its low expense ratio, which is just 0.015%. That means you're paying less in fees compared to most other funds, so more of your money is actually working for you. Historically, the S&P 500 has delivered around 10% average annual returns, which makes FXAIX a reliable choice for anyone looking to grow their investment steadily over the long term. Now, let's talk numbers. If you put $20,000 of your $100,000 into FXAIX and the fund continues to see average returns of about 10%, your investment could grow significantly over time. In 10 years, that $20,000 could turn into around $51,800. And if you keep it in for 20 years, it might grow to about $134,500. FXAIX offers a balanced approach, combining growth potential and stability, which is perfect for investors who want steady returns without taking on too much risk. Chapter 3. Fidelity Total Market Index Fund, or FSKAX. Next up, we have the Fidelity Total Market Index Fund, known as FSKAX. Unlike the S&P 500-focused FXAIX, which covers only large-cap companies, FSKAX offers exposure to the entire US stock market. This means you're investing in not only the large, established companies, but also mid-sized and smaller firms. Why does this matter? Smaller and mid-sized companies often have more room to grow, which adds a boost to your overall returns. One of the best parts about FSKAX is its diversity. It includes thousands of companies across multiple sectors, and just like FXAIX, It has a low expense ratio of around 0.015%, keeping your investment costs minimal. Over the past few years, FSKAX has delivered strong returns, often in line or slightly above the S&P 500, averaging around 9 to 11% annually. So if you're interested in a wider range of companies, FSKAX can provide that broad market exposure. Now, let's put that in perspective with real numbers. If you invested $20,000 here, similar to FXAIX, and the fund continued to grow at an average rate of about 9%, you'd be looking at a balance of around $47,500 in 10 years. And if you hold on for 20 years, that $20,000 could potentially grow to about $121,900. In short, FSKAX is ideal if you want a more comprehensive slice of the US economy. It's a great way to tap into not just the big names in business, but also promising smaller companies that can add even more growth potential to your portfolio. Chapter 4: Fidelity Nasdaq Composite Index Fund, or FNCMX. Moving on to a fund with a bit more risk and potentially higher rewards, let's talk about the Fidelity Nasdaq Composite Index Fund, or FNCMX. This fund tracks the Nasdaq Composite Index, which is heavily focused on technology and innovative companies. With FNCMX, you're investing in a range of cutting-edge sectors, from tech giants like Apple, Amazon, and Tesla, to emerging players in healthcare, biotechnology, and customer services. So why choose FNCMX? The tech-heavy Nasdaq has historically outperformed many other market indices, with average returns around 12 to 15% over the past decade. That means FNCMX offers a strong growth opportunity for investors willing to take on a little more volatility. However, because it's more tech-focused, FNCMX can experience sharper ups and downs compared to broader funds like the S&P 500. But if you're okay with some fluctuation in exchange for the chance at high returns, FNCMX might be the perfect fit. Now, here's what your money could do. Putting $20,000 into FNCMX at an average annual return of around 15% could grow that investment to approximately $81,300 in 10 years. And if you stick with it for 20 years, your $20,000 might turn into an impressive $330,000. That's the power of growth-driven sectors like tech and innovation. FNCMX is a great choice for anyone looking to tap into the potential of technology and high-growth industries. Chapter 5: Fidelity US Bond Index Fund, or FXNAX. Now, let's shift gears and talk about stability with the Fidelity US Bond Index Fund, or FXNAX. Unlike the previous funds, which focuses on stocks, FXNAX is dedicated to bonds, tracking the Bloomberg US Aggregate Bond Index. This includes a mix of government bonds, corporate bonds, and other investment-grade securities, making it a safer, lower-risk option. Why consider bonds in a portfolio? Bonds add stability, especially during stock market downturns. While stocks offer higher growth potential, they can also be more volatile. Bonds, on the other hand, tend to have steadier, predictable returns, often in the range of 3 to 5% annually. So, adding FXNAX can help balance your portfolio, providing a cushion if stocks take a hit. Let's look at some numbers. If you put $20,000 into FXNAX with an average annual return of around 3.5%, your investment could grow to about $28,200 over 10 years. And over 20 years, it might reach roughly $39,700. While it's a slower growth path than stocks, FXNAX offers peace of mind by reducing overall risk and adding steady income through bond interest. FXNAX is ideal for conservative investors or anyone looking to add a level of protection to their portfolio. Chapter 6: Fidelity International Index Fund, or FSPSX. Finally, let's go beyond US borders with the Fidelity International Index Fund, or FSPSX. This fund focuses on developed markets outside the United States, giving you exposure to companies across Europe, Japan, Australia, and more. By investing in FSPSX, you're diversifying your portfolio globally, which can help reduce reliance on the US economy alone. Why add international exposure? Markets around the world don't always move in the same direction as the US stock market. So, investing internationally can act as a buffer when the US stock market faces downturns. FSPSX includes major companies like Nestle, Toyota, and Samsung, providing access to established firms in various industries that contribute to long-term stability and growth. Now, here's what the numbers look like. A $20,000 investment in FSPSX, assuming an average annual return of around 8%, could grow to approximately $43,900 over 10 years. Stick with it for 20 years, and you might see that $20,000 turn into nearly $99,400. FSPSX is perfect if you want to balance their portfolio by spreading investment across different economies and currencies. Chapter 7. Projected Portfolio Performance – Compounded Growth Potential. Now that we've covered each of the top 5 Fidelity index funds, let's talk about what your $100,000 investment could actually grow into over time, if you split it equally among these funds. When you spread your investments across different markets and asset types, like US large caps, total market exposure, tech-heavy NASDAQ, bonds, and international stocks, you're building a portfolio that's both diversified and positioned for long-term growth. So, let's break it down. If each of these funds performs as expected, averaging returns between 3.5% and 15% depending on the fund, you could see your $100,000 grow to approximately $246,000 after 10 years. That's the magic of compound growth. As each fund earns returns, those returns get reinvested, creating a snowball effect where your money starts earning on itself. Now, hold on, because it gets even better with time. If you keep this investment for 20 years, your initial $100,000 could potentially grow to around $725,000. That's more than 7 times your original investment, thanks to the power of compounding and a well-diversified strategy. This mix of funds gives you exposure to both high-growth sectors and stable assets, helping your portfolio grow while staying resilient through market ups and downs. And remember, the real key here is patience, staying invested and letting time work its magic. Whether your priority is growth, stability, or a mix of both, Fidelity Index Funds provide a solid, low-maintenance path to long-term wealth. So take a look at your own financial goals. Think about how these funds align with your risk tolerance and make a decision that future you will thank you for. With patience and consistency, you're setting yourself up to turn that $100,000 into a substantial nest egg. That's it for this video. Thanks for watching.